I really want those people to get every last bit out of what they put in. And the ETF really allows for that with its incredible low cost structure, with its tax efficiency that allows you to defer taking gains until it's your right time to do so. It's a great leveler of the playing field.
Welcome to Knowing Me, Knowing You, the podcast for the future of wealth management. Thanks for being here. I'm Marla Sofer. Money is a tool. It empowers people. Let's dive into how technology is personalizing advice, strengthening connections, and creating lasting impact. If you're an advisor looking to differentiate, a fintech leader shaping the next wave, or a client ready to take control of your financial future, you're in the right place. Let's get started. Hello, and today we are thrilled to welcome Elisabeth Kashner to the Knowing Me, Knowing You podcast. Elisabeth is a true pioneer in the world of ETFs and fund research, with a career that has shaped how investors and advisors understand these critical tools. As a VP and Director of Global Fund and Analytics at FactSet, and formerly one of the original members of the ETF.com and Inside ETFs research teams, and a founder of Women in ETFs, Elisabeth has spent decades diving deep into the structures, cost, and behaviors of ETFs. Her groundbreaking research has helped make fund investing more transparent and accessible for everyone, from institutions to everyday investors. Beyond her professional work, Elisabeth is deeply committed to volunteer leadership, social impact, bringing her analytical skills to organizations that foster community empowerment and innovation. Today, we're going to talk about how data is changing the way investment products are created, how advisors and clients can better navigate today's complex fund landscape, and where the future of ETFs and wealth management is heading. I met Elisabeth when I was at BlackRock, going back to 2011, I believe, as part of Women in ETFs and getting involved. I am a huge fan of all of her work and delighted to welcome you today, Elisabeth, to the Knowing Me, Knowing You podcast.
Oh my goodness, Marla, I cannot possibly live up to that introduction. That is too kind of you.
You certainly have lived up to it. And I think I get involved in a lot of really important, impactful investment trends. And so we always start off the podcast with what is most exciting to you about the moment we're in and the future of wealth management?
Oh gosh, Marla, I think there's just such an opportunity right now for financial advisors to help their clients be their best selves. And the reason that I say that is that there are so many amazing investment products and model portfolios that are available that the piece of wealth management that was once so difficult, was the actual investment management piece, is now really incredibly simplified. You can put together an easy all-weather portfolio using 3 or 4 ETFs, rebalance it as needed, and just move forward, or you can, solve for slightly more complex client needs. But you no longer have to be spending, huge chunks of your day just managing the stocks, bonds, and funds that your clients own. And so to me, what that means is that advisors are able to truly advise, whether it's on asset location, tax efficiency, behavioral support, helping understand the legacy and estate planning process. I think all of those are incredible value adds. And, when you get in a topsy-turvy market like the one that we've had this spring, it's not easy helping investors be their best selves.
It's so interesting because you have such a deep view on vehicles, on kind of, this is an ETF vehicle and how it operates. And here's the ones that you should be taking a look at. Here's the future of how ETFs should work. And it all boils down to help clients be their best selves. Just use the tool to help the client live the life they want to live. And what I think a lot of advisors listening to this podcast are interested in is, gosh, there are so many products. I think there's more ETFs than there are public equities, aren't there?
We're getting close. I think both are right in the 4,000 level.
Yeah. So it's wild that there are just that many ETFs have kind of hit the market, and it's so confusing and overwhelming. And so now you have ETF strategists and models, and everyone's kind of trying to tell wealth and managers, buy me, buy me, buy me. And they are left to their own devices, not to mention individual clients, to help make sense of it. And how do I make sure I'm buying the right product? And I'll add on top of that, how do I know which are truly differentiated and which are more or less the same thing with a different label on top?
Great question, Marla. FactSet's funds analytics business is built around this problem of choice. That, when I started back in 2010 as an ETF analyst, we thought there were a lot of products then. And the day I started, there were 968. And we're now well over 4,000.
When was that? What year was that?
It was 2010.
So 968. So it has quadrupled in the last decade and a half.
Yes. And a lot of that has just come in the past few years after the SEC issued the ETF rule, otherwise known as 6C11, that made it really easy for asset managers to launch new product. A lot of the hurdles that had previously been there about needing to get specific exemptive relief and having different terms and conditions from one provider to the next, all of that was pretty much washed away. And then we just saw so many funds launching. So as confusing as it was when I started and there was a need for decision assistance, it's only gotten much worse. So, what we do at FactSet is we start with a really high class, very differentiated, very multi-layered, fine-tuned fund classification system that allows a user to really pinpoint the exact type of fund that they're using. Because just because there's 4,000 funds out there doesn't mean that they're all fit for purpose, right? And once you understand what your purpose is, perhaps it is a intermediate or broad-based municipal bond ETF. Maybe there's a specific state, right? Maybe there's a specific credit quality. All of a sudden, you can find yourself with a much more manageable set of products, right? If what you're looking for is somewhat undifferentiated US large cap, well, sorry, that's still a hot mess.
I wonder actually I don't know if you've ever taken a look at this, but how many of those 4,000 ETFs are truly unique from the rest of the pack? And how many of them are kind of just another version of the same?
There's very few products that are completely mappable one-to-one on top of each other.
Right. There's licensing issues as well there, right? They've got to, yeah.
Well, yeah. And also just, the competitive landscape. So the big three all have S&P 500 products and S&P 1500 suite. They have Russell products, the sort of big brand name, easy equity suites. And in some cases, some of the Bloomberg Barclays fixed income products, like those you will find true duplicates. Although if you actually look super carefully, just to get really nerdy on you for one sec, you would think that the Bloomberg Barclays aggregate bond index is the same wherever it goes, but actually Vanguard uses a float adjusted version of it, whereas BlackRock uses just the off the shelf version. So even those two products are not 100% similar. They're, I'm not going to go splitting hairs with you about it.
No, but it does require kind of that like nuance. Like it really depends on what is it that you're looking to use it for.
Yes. But and here I think is where there is some disconnect between the advisor community and the asset manager community, because outside of those handful of actual copycat funds, what you have is a whole mess of what the industry calls product differentiation, right? Where one fund that's launched might be a teeny weeny little bit different than another fund that is launched. They're all trying to differentiate from each other. And that makes for a potentially good marketing pitch on the part of the asset manager, but also a very confusing situation for the wealth advisor.
Absolutely. So when you think about the wealth advisors decomplicating, when they're trying to make it much clearer for themselves and for their clients, and they're kind of picking through and learning, beyond going into FactSet, and if you don't mind, kind of repeat, where can they go to just go and do some digging? I know a lot of them go to Morningstar or Yahoo Finance or FactSet, but what is it that you would suggest that they look for?
The very basic pieces of due diligence are understanding the efficiency, the tradability, and the fit of the product. The efficiency is like long-term holding costs and risks. Holding costs are pretty well estimated by the expense ratio, but if you have a fund that has a lot of turnover and is not doing it in a tax efficient manner, or if you have a passive fund that doesn't track its index super well, those actual costs can work out to be a little bit higher than you would expect. You certainly want to look for some durability. So the higher the asset level, the more likely the asset manager will stick with the product rather than shutting it down. And, the asset manager, even if it's a low asset level fund, if there's inflows going in, it's growing over time, they're probably more inclined to keep it open. For trading, a lot of wealth advisors will have trading support in-house, but you should always understand what the trading spread is, how liquid the underlying portfolio is, and don't hesitate to trade away and call in a third-party liquidity provider to get really good estimates and execution. That might be very helpful. All of those are mechanistic questions that you need to ask and answer and understand. The bigger one by far, though, is fit, which is what we at FactSet talk about, like fit for purpose. How does this fund fit with your client needs? Is it taking a lot of additional uncompensated risk that it really doesn't need to?
That was such a fantastic answer, because what you're giving to the listeners here is really easy way to remember what they need to be looking for: efficiency, including durability, tradability, and fit. I'm curious to understand, Elisabeth, you have been involved in ETF research since the early days. What drew you in to ETFs? What has kept you passionate? And if you don't mind, also, you were just sharing with me a personal story about how ETFs are evolving, and you can kind of pair in, how are you now doing research that is keeping up with the capabilities and the fit of the ETFs with your new use cases that might be needing them?
Great question, Marla. So, I think the primary thing that drove me to love ETFs and to want to spend the last 15 years of my life deep in the weeds of ETF due diligence is that technologically, they've been a game changer, right? They've taken what used to be investment strategies that were available only to giant institutions, pension funds and the like, and made them available to anybody with a couple $100 in a brokerage account. And so the ability for an investor to put nearly every penny to work and to keep nearly every penny working over time, that's something that is remarkable. And it warms my little cheapskate heart. So but in all seriousness, so many people out there, it's a struggle for them to save any money in the first place, right? To have the capability and the discipline to do that. I really want those people to get every last bit out of what they put in. And the ETF really allows for that with its incredible low cost structure, with its tax efficiency that allows you to defer taking gains until it's your right time to do so. It's a great leveler of the playing field.
I love it. So the primary things that brought you in, it sounds like, are the democratization. It's access for all. You can all put your money to work with down to $100. I think you can even go lower these days. You can buy $5 into an ETF, on some platforms. The value. So the democratization, the access, and the value. And you were sharing that, in your life, you kind of had a diversified portfolio, and then you kind of thought differently about, you're doing some real estate work. You thought it was going to be, long term, and then you had to do some shuffling. How are ETFs evolving to accommodate some of those types of changes?
Yeah. So Marla, it's really a story. My husband and I, our last kid went to college last fall, and we celebrated by buying a fixer-upper to turn into the empty nest of our dreams. And a fixer-upper, you got to pay the contractor in cash, yeah? So all of a sudden, we had been long-term investors and really disciplined, held the course during market corrections, rebalanced back into equities at more or less the right time. And so it was a real shock to say to ourselves, wait a minute, for a portion of our portfolio, our time horizon has changed. We have no business being in long dated assets with a short dated need. And, my first instinct was like, okay, fine, we'll sell off some of our positions and we'll buy some T-bills or we'll buy a high quality treasury money market fund. But then I remembered, Elisabeth, you're an ETF analyst. There are some ETFs out there that are, exactly designed.
I see you talking to the two people on your shoulders. Wait a second, Elisabeth, this is what you do for a living.
Yes, indeed. Yes, indeed. I specifically thought about some of the target outcome products, the buffer funds. I'm sure all of the advisors in your audience know about these defined outcome products.
I would actually take a moment and assume they don't, if you don't mind, at a high level.
No worries. The reason I'm assuming they do is that when FactSet gets 13F data, we see who's buying these products, and they are heavily used in the advisor community. And I've heard anecdotally that clients are demanding them. So I rather suspect that even if your listeners didn't want to know about them, they do now.
Excellent.
So these defined outcome products are ETFs that use options to change the payout profile of popular indexes such as the S&P 500 or the Russell 2000, EFA, NASDAQ, etc. And the first ones just used a pretty simple put spread to create a zone of downside protection, although there was exposure below that. But as these products have become more and more popular, they've come out in a lot of different flavors. And the one that I looked at was one that they're called the 100% buffer products. And at launch, they have a put that's at the money. So if you should buy it, initially on launch moment, at $25 NAV or whatever the launch NAV is on the button, you can know that aside from the trading costs that you've paid and the expense ratio that you will pay, that you won't lose any money in addition to that. And to fund the purchase of that at the money put, they sell an out of the money call on a $1 to $1 ratio. That means that as a holder, you do have some upside available, right? And that's what clients are paying for. They're willing to pay the trading spread. They're willing to pay the management fee in order to feel like, oh, I've got this great deal. I'm never going to lose money and I could potentially make some money. So I thought to myself, like, okay, let's take a look at these products. And I wound up publishing a blog about them. They came out last week. And long story short, Marla, before I was an ETF analyst, I was an options trader. So I knew the options business very well. I did that for 7 years. It still took me a week to really take these products apart, figure out how they work, and design a good due diligence rubric for them. They're that complicated.
What if financial planning wasn't just about numbers, but about you, your values, your goals, your vision for the future? Nomi is transforming client discovery for wealth managers, going beyond assets and risk scores to uncover what truly matters. With behavioral insights and real-time data, Nomi helps advisors personalize advice, build deeper connections, and grow their businesses. Because the best financial decisions start with knowing you. Discover the future of client engagement at nomi.com. Yes, I think some people might have gotten lost even in your overview as you were explaining, here's how they work. And so I think what's great is, okay, you kind of gave us that high level overview and you recognize that, yeah, it takes a week to go deep. Even if this is your job full time, they are a complicated ETF. And I think in your learning as you went in and dug deep for a week, I'm also curious, like advisors who might have been doing this and they are familiar with kind of the downside protection and using options and different ways to protect. Why within the framework of an ETF? Why in an ETF vehicle?
Well, it's much so there's pros and cons to these products, as you might imagine. And in the end, I decided they're not really for my family. I didn't like the upside downside as available traded in the market right now for the time frame that we were looking at. For something that is a capital preservation product, I thought it was just too costly. But, why are they so appealing and why do so many people want to use them? Like, trading options is difficult and can be expensive. And, a lot of advisors and individuals don't feel confident necessarily entering an options trade. I know as a former options trader, I spend my whole day waiting for someone like me to come into the marketplace because as a retail investor, I don't know what I'm doing. I'm going to overpay, right? And so, in this case, you have the options trades are all put on professionally, all done at one time. Presumably large asset managers such as First Trust or BlackRock have a little bit better go of it negotiating deals in the options market. But I think also just from a mechanical point of view, you don't have to worry what happens when your options expire. They'll be re-upped for you if that's what you want. There's also some tax transformation. And this part is gosh, I'm going to get super nerdy on you, Marla, but in the ETF format, you only realize the gains when you sell the ETF, and options otherwise would be generating ordinary income. But because they're there in the ETF package and they're sort of managed carefully through the creation redemption process, you wind up just having capital gains. Now, in a state like California, you and I are both in the Bay Area at the moment, treasury bills are taxable at the federal level, but they're not taxable at the state level. The interest, of course, is taxable as ordinary income. Capital gains sounds like it's a better deal until you realize that two things. One is capital gains are taxable at the state level, and California is a pretty high tax state. So you have to factor that back in. But also for this particular use case, I was looking at products that matured at the end of the calendar year. That would be a short-term capital gain. And guess what? That's taxed as ordinary income. So whereas a T-bill would be taxed as ordinary income only at the federal level, in this use case, 100% buffer fund would be taxed at ordinary income at both the federal and the state level.
I love that we had an opportunity to go deep diving into a product that advisors are hearing a lot about. You said that it's being taken up. FactSet has proven that. Clients might be asking for it. I often have the question of, are clients asking for it just because someone is out there pitching it really hard? Like it's being sold to the market as aggressively as it can possibly be sold. So I would love to ask you this question. If you could redesign the investment product landscape from scratch, what would you do to prioritize simpler, better alignment with how people actually live, how they invest, helping wealth managers help normal, ordinary people just make better choices that incorporate, different perspectives and risk and values and history and what they want their money to achieve for them?
Marla, I think for most investors, the initial question that they ask themselves of what is my target asset allocation is the most important and the hardest question to answer. Everything after that is more details. And for the vast majority of clients, broad-based, simple, cheap products like, suites from Vanguard, suites from BlackRock, State Street are pretty much all you need, right? You need some smarts about what goes in your sheltered accounts versus your taxable accounts. You need to figure out how you're going to manage cash flow. You might have some additional special needs that require tinkering with things around the edges. But honestly, the best tool that I can give an advisor after doing deep due diligence in the FactSet workstation is a pair of dark sunglasses and some earplugs to drown out the lights and the noise, right? Pick something simple, durable, broad-based, and make sure that you've picked the right thing for the right reasons. And then, man, there's a lot of other harder questions to answer out there.
I love it. That's fantastic advice. And to me, it is to synthesize. It's just stop getting distracted by the shiny objects. Research has proven time and again that it is the boring, cheap, basic allocations that align with what you need it to do and when you need the liquidity, and in asset location, just like which ones need tax optimization and which don't, or how do you kind of put what into what bucket. All the rest is bright, shiny object, is kind of how I'll restate what you said for many people, for most people. Not everyone, of course. So I think that was great, just to kind of say, look, if we could redesign it, we would make it simpler. And here's how to do that. Did that restate it effectively? Anything else you would add?
No, I think that is perfect.
We always end with a question about what is one instance in your life or a conversation you've had that has changed your own personal relationship with money.
I think this experience of saying, honey, I really want this house here and I want to make it our dream house, has been for me kind of the first time in my life that I've wanted to really spend money on something. I've been fabulously cheap for many, many years and a great saver. And now all of a sudden I'm asking myself, well, wait a minute, what is the money for actually? And how can I use it to maximize my enjoyment of something and to do it in a way that feels true to who we are, right? So this is not like an expensive cruise somewhere or flashy clothing. This is, the shelter from the storm, the everyday place where we both live and work. It's where we shelter family, entertain friends. I'm really happy that for me, the really good financial habits that my parents brought me up with have put me in a place where I can start to ask the question, what would I like my money to do for me?
Oh, what a fabulous place to end. And I'm sure it resonates with so many of our listeners. That's really what this podcast is all about. The future of wealth is really about asking that question. What do I need my money to do for me? And I think that you just told such a beautiful story, and it goes down to the basics and what you're looking for. You're looking for an opportunity to shelter, to house, to welcome others in. And that's so beautiful. I'm so grateful to you for sharing your insights, your experience. Your work has opened the door to a lot more transparency, decoding very complex products for a lot of people who struggle to understand what should I be doing and investing in, and a more thoughtful future for wealth management, kind of making that edge between asset management and wealth management a little bit clearer and more understandable for the people listening here. Where can our listeners learn more about your work, what FactSet is creating, the research that you do specifically, the blog you recently wrote, if they want to dive deeper?
Thank you for asking, Marla. You can read my blogs on insight.factset.com/author/Elisabeth-Kashner-CFA. And you can always just Google Kashner FactSet Insight and it'll get you to the same place.
And we'll put a link here in the podcast episode as well, so they don't have to go looking for it.
Totally fair. And, just to see the products that my team and I contribute to with FactSet Funds Analytics, go to factset.com, look under some of our wealth offerings, and you can certainly reach out to me and I can connect you with some of our client relations teams who can help walk you through.
Fantastic. Elisabeth, thank you. For our listeners, as a result of listening to this conversation, how are you thinking differently about the ETFs that you might recommend or other funds or investments after listening to today's conversation? I would love to hear your thoughts. If you think that other people might be interested in hearing about how ETFs are evolving, what advisors should be looking for when they're evaluating. I think one of the best snippets from today was focus on efficiency, tradability, and fit. It's a really easy way to assess your ETFs and know what you're going in for. So please share your comments with me, and I look forward to hearing from you next time. Thanks, Elisabeth.
Thank you, Marla. What a pleasure it's been.
Thank you for joining us on the Knowing Me, Knowing You podcast. If you enjoyed this episode, share it with someone who needs to hear it. And don't forget to subscribe, rate, and review. Your support helps us bring more transformative conversations to you. Until next time, keep discovering, keep growing, and remember, you're in control of your own financial story. Follow us for more conversations on financial confidence, self-discovery, and the future of money.